Why is Buffett holding $300 billion in cash and just watching the market recover? Is he getting too old? Or does he know a secret that Adam Smith warned about 200 years ago? That this system is designed to devour those who arrive late. Today, we're going to expose the massive trap being set under the label of economic recovery. In the winter of 2025 to 2026, millions of American households felt the first sting of the tariff shock. Prices climbed on clothing, food, appliances, and other everyday essentials imported from abroad. Low-income families, who already devoted the largest slice of their budgets to these tradable goods, absorbed hundreds of dollars in extra costs each year, even after courts stepped in to limit some of the damage. According to analysis from the Yale Budget Lab, the short-run price level increase from the full tariff regime reached about 0.6%, assuming expiration of certain broad measures post-ruling, translating to an average household loss of roughly $600 to $800 annually, with the bottom income decile facing around $400 in added burden. Small businesses, without the scale to reroute supply chains or swallow rising input prices, either raised their own prices and lost customers, squeezed margins until they bled, or simply closed their doors. Community banks that lent to those local businesses watched their loan books weaken, while the largest financial institutions quietly shifted toward trading desks and wealth management services, where lighter regulation gave them breathing room. The market tremor hit hardest in late 2025. After the Liberation Day announcement of sweeping tariffs invoked under emergency presidential powers, the S&P 500 lurched downward. Volatility surged as uncertainty over policy and cost pass-throughs thickened. Liquidity dried up in trade-sensitive sectors. Correlations spiked when headline-driven selling cascaded from retail accounts. The trigger was not some slow-building credit unwind inside the financial system. It was an abrupt, exogenous policy move, an executive declaration of emergency that bypassed Congress to impose broad duties on imports. The deeper instability had been building for years. Stubborn fiscal deficits, high public debt, and the lingering unevenness of a K-shaped recovery from earlier cycles. The tariffs did not invent those fragilities. They merely exposed them. Leverage had already piled up off the balance sheets of the biggest banks and institutional investors, hidden in derivatives, margin financing for private equity, and crypto positions increasingly woven into retirement accounts. On the balance sheets themselves, the giant institutions held clear advantages in hedging tariff swings. Ordinary households and small businesses carried their exposure naked, with no tools to offset it. The institutions that had structured much of that leverage counted on regulatory forbearance and emergency liquidity lines to keep it manageable. Everyone else remained a price taker. At every step of the escalation, tariff rollout, courtroom battles, market dips, the advantages flowed asymmetrically. Large importers quietly secured exemptions. Financial giants tapped lobbying networks and sophisticated hedging instruments unavailable to smaller players. Regulatory influence traveled through familiar revolving doors and concentrated sway over agency rules. Public messaging consistently framed the turbulence as short-lived policy noise rather than a regressive structural burden. Legal protections insulated executive action until the judiciary finally intervened. Was this concentration of gains accidental, or was it baked into the incentives? Adam Smith saw the pattern clearly in The Wealth of Nations. He explained how the division of labor and patient capital accumulation generate widespread prosperity when people pursue their self-interest inside genuinely open, competitive markets. Yet he also cautioned against the distortions that arise when monopolies, exclusive privileges, or government favoritism concentrate rewards in the hands of a few. In this episode, deregulation and the extension of corporate and high-earner tax cuts accelerated returns for the largest players. They captured the rebound in asset values, especially in AI-powered Nasdaq leadership, and hedged their risks with precision. The invisible hand, intended to channel private game toward public benefit through competition, instead steered benefits upward. Corporations passed tariff costs straight to consumers and small suppliers while retaining fatter after-tax profits and scale-driven advantages. Smaller enterprises, unable to specialize or accumulate capital at the same pace, absorbed shocks they could not escape. The precise mercantilist favoritism Smith warned against, in which policy protects the already powerful rather than liberating productive capacity across the whole society. Counterpoints and upsides. Not every outcome tilted downward. Markets reacted positively to the February 20th, 2026 Supreme Court ruling invalidating the broadest IEEPA tariffs. The S&P 500 rose about 0.7% that day, while the Nasdaq, buoyed by AI momentum and deregulation tailwinds, gained nearly 0.9%. Protected industries like energy and manufacturing saw potential job gains and improved margins from reduced foreign competition. Remaining Section 232 tariffs on steel, aluminum, autos, and similar sectors were projected by the Tax Foundation to generate roughly $635 billion in revenue over the next decade, 2026 to 2035, conventional basis before dynamic effects, helping offset part of the widening federal deficit. Potential refunds from the invalidated tariffs could deliver billions in relief to importers, though claims skewed toward larger entities best positioned to pursue them. CBO projections incorporated tariff effects, forecasting unemployment rising modestly by about 0.3 percentage points to around 4.6% by the end of 2026, amid other factors like immigration policy changes. Liquidity pooled inside the systemically important institutions that suffered the smallest net losses and quickly became indispensable again for market calm. The real damage migrated downward. Households paid through higher prices and through reductions in safety net programs such as SNAP and Medicaid. Political influence showed itself in deregulation that favored financial sector profitability over broad-based lending, in the swift passage of tax cut extensions for corporations and high earners, and in the reframing of documented economic warnings as mere unexpected volatility. Central bank backstops stayed on standby, ready if needed, while the Supreme Court's ruling forced refunds, mostly to the large importers best equipped to claim them. Uncertainty persisted, however, and within weeks, a replacement 10% global surcharge appeared. The underlying architecture remained intact. Concentrated corporate and financial capital, allied with broad executive discretion and shielded by sheer scale, held the field. Low and middle-income households and small enterprises bore the regressive incidence of costs and the erosion of supports. A precedent was set. Sweeping executive trade authority faces constitutional boundaries, yet policy can pivot quickly to preserve the upward tilt. Deregulation locked in market share gains for the biggest players. Leverage simply migrated from tariff-exposed trade to alternative assets and derivatives operating under looser supervision. The seeds of the next stress are already visible in the present solution. Federal deficits are projected to reach $1.9 trillion in fiscal 2026 and climb toward $3.1 trillion by 2036, according to the Congressional Budget Office. Public debt is on track to exceed 120% of GDP. Growing deficits, mounting interest payments, and dependence on asset price inflation to paper over uneven growth all embed deeper fragility. Risk continues to migrate downward, while leverage concentrates still further inside private markets. The system that allocates risk endures well beyond any single policy reversal. In periods of such pronounced asymmetry, the clear-eyed observer preserves capital by seeing incentives for what they are, not in the rhetoric of broad prosperity, but in the quiet machinery that consistently directs gains toward those who already hold capital. Markets may reward patience, but they seldom forgive those who mistake temporary policy windfalls for genuine structural safety.